Hi there, welcome to the latest video, and there's a lot of talk of buying the dip. So I sort of looked into it. I thought, when should you buy the dip? When should you avoid buying the dip? And I try and work it out in some way. And I try and give some logic to that. And I give two reasons why I should buy the dip, and maybe you should buy the dip. And other reasons why you should avoid buying the dip. Okay, so I do that, and I also look at my performance investing over the last 11 years. I've discovered that now. I'll show you a letter from Barclays that show how far data goes back on my app. Plus, I also look at the performance of the companies I've mentioned on video over the last 2 years. And by the way, if you want the next video to your inbox, hit the subscribe button and notification bell. Okay. All right, let's get into it. Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. Okay, should you or I buy the dip? There's two reasons why we should buy the dip, all right? Because we don't want this to happen. I just bought the dip, but it keeps dipping. That's not what you want to see happening, all right? First thing is, the trend is your friend. I'm talking just generally in investing. Themes that are mega trends that you know are going to be here for a long time. For example, electric vehicles. You know, that's going to be a big trend for a long time. Like I said, 3-4% now of the vehicles on the road are electric vehicles. But by 2030, pretty much around the world, you're no longer allowed to buy petrol diesels. So that's a big trend. You stand in front of that trend, invest in that trend, and you'll do well. All boats will rise in that trend, you know. So don't go against a trend. If you're buying the dip, make sure it's in an upward trend. So this is a NASDAQ, for example. That's a dip. This is an upward trend. That's a dip. That's an upward trend. Okay? You're okay buying these dips. That's very good. Now, right now the trend of the growing economy has been disrupted by COVID. All right, so we've seen a lot of stocks dive, a lot of growth stocks dive, because they've been hit by COVID. We've seen a lot of COVID testing stocks do well. That's counter trend, of course, because they're the only things that can prevent this COVID disease carrying on, apart from a vaccine. So the economy will, with the help of vaccines, and I know there's lots of people who think, vaccines are not safe, they don't work. Let me just say one thing, and I keep saying this, and I keep getting people maybe on social media saying, I'm not going to take it. That's not the point. The reason why the economy is locked down is because vulnerable people are dying from this, right? Older, elderly people are dying from this. People on the front line are dying from it. And the hospital beds are filling up. That's why we have to stop the spread of it, to stop our hospitals filling up. So if we can prevent that strata of people in society not dying from it by vaccinating them, then we can open the economy back up, because those people are protected and they won't have to go to hospital, hopefully, And people are saying, I don't know if it's safe, I won't take it. But generally, you won't need to take it, You'll probably contract it and it won't do you any harm. But if the options are you will die or you take a vaccine, what are you going to do? So I'm saying, and let's be honest, even the Pfizer one, I'll go into this later, but it baffles me how people don't get that our economy is suffering because we're shutting down the economy because we have to protect that strata of vulnerable people. Once we can protect those, we can open the economy back up. So look, this happened in the week. Big Pfizer vaccine day, massive. Look at all this. COVID vaccine breakthrough fuels broad global equity rally. COVID-19 global stock markets rocket on vaccine hopes. FTSE 100 records best week since April as COVID vaccine triggers hopes for economy. And I said the majority of stocks, apart from big American tech stocks and COVID test stocks, it's good for them. It's good for all economies. Our economy being locked down it's not good. And I'm not saying COVID testing stocks won't be here for a while. They may be, but this is what's going to happen. I saw that as a massive tidal change that day. And there's more vaccines coming out. So this is what I'm saying here, all right? If you think more positive news on COVID vaccines will impact the share price of your company positively, that means if your stock rose on last Monday, when Pfizer came out with the news, then buy the dip, all right? I don't think that's Warren's one of Warren's more well-known quotes. But this is a start. Like, for example, I'm talking about travel, leisure, banking, hospitality stocks, all went crazy on Monday. That's going to continue happening. Now, if you think more positive news on COVID vaccines will impact the share price of your company negatively, sell the rallies. Honestly, sell the rallies because it's going to keep happening. Do you know why? You know, look at this. If you bought the dip there, went down. I bought the dip there, went down. Bought the dip there, went down. You need to sell these rallies. Sell these rallies. Sell them all. Because the trend is starting to move in favour of a growing economy. An economy reverting to mean. Because, listen, there's more positive news on vaccines coming. Look at these. These are COVID-19 vaccine production goals. This is 2020 in blue, Pfizer 100 million, and 20 million Moderna. That's the next one to report. Exactly the same tech as Pfizer, pretty much. So there's a high level of confidence in that vaccine also having high efficacy rates, being very effective and safe. Let's be honest, they're testing tens of thousands of people are taking this vaccine. Tens of thousands. There's been no safety issues. So safety is not a worry. But again, the vaccine, if you're going to die of COVID or you take a vaccine, you see that option there. This is the big one. This is the game changer, okay? These have to be stored at minus 80 degrees. It can be done. There's cold chain suppliers that just ship them out in dry ice. They can spend 5 days in a normal freezer. And obviously that's the local centres. They're going to be vaccinating about 5,000 people a day, they've written, before the end of the year. And that can be done, but it's logistically hard. They're also very expensive, about 30 quid for a double dose. These are 3 quid for a double dose, a tenth. That's 10 times the price of AstraZeneca. Look at the figures here, 400 million. That's gone down a little bit now due to supply chain issues. But this is the big deal. I think this will be easily, to supply this, to get logistics of this is a lot easier, especially in developed worlds as well, because it didn't have to be held at minus 80. It can be held at between 2 and 8 degrees. And so that'll be shifted around. Then you've got J&J coming out. These are obviously 2021. Look at the billions of vaccines coming out. And people say it's not safe. First of all, the numbers suggest they are safe. Secondly, the FDA standards that are around today came about because of thalidomide. Okay, thalidomide, I don't know if you know about that, in the 60s, 70s, it went commercial. It didn't get past by the FDA. There was an independent clinical trial that went down and they started selling it, but now you can't do that anymore. So, they said all the mistakes made in the past have led to what we have, the regulation we have today. And so it's a lot more stringent. And of course, there are some side effects sometimes. And I'm one of the people who say, well, actually, you don't actually know if it's entirely safe because we don't have the time to evaluate it like we do with normal clinical trial drugs. We can take years sometimes. But, nevertheless, initial safety data and efficacy on Pfizer is phenomenal. 90% efficacy. Whereas flu vaccines, achieve around between 40 and 60% every year. That's 90% effective. All right, so you can see, even if you only have to get 50% effective rate to get past FDA clearance, and obviously it has to be safe. So that's way above that level. This is orders by the UK government. Okay, they've ordered 100 million AstraZeneca ones. Now, Pfizer's come up first, of course. Pfizer and BioNTech, 14 million was ordered by them, 60 million by Novavax, and 100 million by the... But this is a game changer, I think, around the world. AstraZeneca will be a lot easier to supply. And if you get good news on AstraZeneca, I think stocks will go bananas, absolutely bananas. And I just think, we're in for a massive rally, a massive one. And worth looking at, when you look at trends, just not on themes, but on technical levels, on charts. The 200-day moving average is seen like as long-term trends. It's the bull bay. If your price is above that, generally speaking, you could have got above and back alert, of course, so you can have or can dip down and come back above it. But generally, if it's above that line, it's bullish. Below that line, bearish. If the price consistently trading above there, see, it's bullish, and so that's the way I look at it. So look at the FTSE. This is very interesting. The FTSE on Monday, boosh. Oh, don't send. The FTSE on Monday. That's the red one is the 200-day moving average. Right? It went above the 200-day moving average on Monday alone, and now it stayed above that. That is very bullish. Let me just look at some other stocks, and I'll show you some other stocks here, okay? Let me move my bald head out of the way. Let's have a look here. Bigger caps. So Greggs is the latest officer, above the 200-day moving average on Monday. Boof. Lloyd's, that's food, of course, inner cities and all that, even though they're cutting down on some of those. Lloyd's, banking, above the 200-day moving average, right? EasyJet, travel, above the 200-day moving average. Hollywood Bowl, leisure, above the 200-day moving average, all right? Safe Stay, which is hostels, travel, look at that, above the 200-day moving average. As far as my stocks are concerned, so even Escape Hunt, which is lesser, it went above that a few weeks back, but of course it's doing very well, it's very oversold. But so that's worth looking out for, generally that level there. And now, if your stocks are, as a result of COVID coming down, and they're going down below the 200 moving, be wary of that. Are they coming into a downtrend? If they're in a downtrend, you've got to sell the rallies. Don't buy those dips. You're in a downtrend. All that'll happen is you'll buy the dip. It'll come up a little bit. If you don't sell that, it'll go down again. So be wary of that. And reason 2, the company's fundamentally cheap. This is another reason why you should buy the dip. Okay, if they have a financial goal, guidance, and you think it's cheap, the share price has gone down now, or it's many multiples. I'll give you an example. It's one of my stocks I hold. Salt Lake Potash, 174 million market cap. Okay, they're going into production in March. Now they'll be producing 245 kilotons per annum of sulfate of potash, which works out about 111 million Aussie dollars. That's 60 million pounds EBITDA cash, pretty much. They'll be generating that per year. Okay. Now, if based on one lake, this is valuations. A low valuation is 5 times. Medium is about 10 times. Upper is 15 times. So from this level, 60 million EBITDA. From this level, let's say 5 times EBITDA is 300 million. That's a 72% increase on current valuation on one lake. Okay, that's taking into account the 175 million market cap. Okay, now let's say the share price dropped to 150 million. We're just taking the low all the time. That's a 100% increase. So we've gone from 72% increase to 100% increase. So maybe if the share price dips to like that level, you'd buy the dip because, hang on, there's more upside here. They are going to be producing that starting in March. Now, if you look at the aiming to place from 3 lakes within 5 years, that's a million, tons per annum. Pretty much, okay? So let's go for the low estimate again. This is being very conservative. Low estimate, 5 times EBITDA. That's 240 million of cash. Times that, 5 times that is 1.2 billion. Okay, so that's a 590% increase from current valuation, from 174 million. Now, if it dropped, for example, the share price dropped and where you got the 120 million, that would increase to a 900% increase on that valuation. So to get to that, take a 900% increase. So you can see sometimes the share price dips. And they've got a financial goal they're going to hit pretty much on a low value and a conservative valuation of 5 times EBITDA. You think, well, that's cheap now. You can ignore the chances of that's cheap. I'm in it for the long term. I'm a long-term investor. They're going to be doing that. I'm going to hold it. And by the way, I'm looking at 1.2 billion on 3 lakes. Okay, 1 million. They've actually got another 6 lakes after 3 lakes. So you can times these numbers by 3 again. So what's that? 3.6 billion on the 9 lakes. That's being very conservative. I don't know if they get 9 lakes, but they definitely, Tony said, you definitely want to get to 3 lakes within 5 years. So even that, pretty much is on a low multiple. I don't think it will be a low multiple. I mean, SOP is a premium product. I think it'll be a lot higher than that. So I think it'll be close to that, pretty much. So there we are. So that's conservative on a low multiple over 3 years, 3 to 5 years. Okay, so and they've got all these other lakes, like I said, to do. So they've got lots of optionality there. Okay, this is my performance in the stocks I've mentioned over the last 2 years on video. If you'd invested $1,000 in each one of the stocks I'd mentioned, Powerhouse is a bit better for. By the way, the most recent stock I've talked about is Escape Hunt. It's up 100% already since I first mentioned it on the video there. Like 100% done. If you'd bought in when I first mentioned the video, that would have been that. But if you invested $1,000 in all these stocks I'd mentioned, what are they? I'd say most of them have performed well, but you'd have returned on 21 grand, 35 grand. That's a profit of 14 grand, a return of 71% over the 2 years. All right, on those stocks, if you put $1,000 in each. Nice to see sort of safe day coming back. It was down at 80% because, of course, the rally happened, like I showed the chart. It came back a little bit. There'll be more rallies, massive rallies. We'll have stimulation as well from stimulus from governments. So I just think, the sooner we get more news on vaccines, the stock market will rally. This is my performance to the 13th of November. 3 months, 20%. 12 months, 63%. Over 36 months, 3 years, 565%. And I got this letter from Barclays. I wanted to find out the app and the website on Barclays Brokers is different. The data goes back further on the app, which is very odd, I thought. But they explained it to me. And they said on the website you can go back to the August 2017. That's why I do 3 months here. That's a screenshot from the website. But he said the app goes back to 17th to 11th, 2009. So that's 11 years pretty much this week. So I've got 11 years worth of data from the app. And they do say a figure there is pretty projection of what data is, but I've worked it out, and it's, I do know what I started off with. So the smart investor, from the 17th to 9th, that's 4626% increase, which is around about 56 times my original holding. All right. Hope that provided some value in some way. If you liked it, give it a thumbs up, like I said, and hopefully I'll be doing a video next week. But so listen, in summary, should you buy the dip? If it's a dip in an uptrend, yes. If the company is fundamentally cheap and you have this financial goal, you know what they're going to be achieving in a few years' time. Not if you're guessing, but if you know what the production is going to be or what they're going to be producing or whatever. So you have to have some kind of, understanding of what they're going to be generating in cash in a few years' time and say, well, compared to, now, obviously there may be some risks they may not achieve that, but I'm willing to take that risk that they will achieve that goal. And so you realise they're very cheap compared to where they could be in 3 to 5 years' time. And that, again, is, like I said, a trend in earnings. The earnings will be growing. So if you have a dip in the share price and the earnings are growing, the price should follow in the end. Thank you for sticking around. Much appreciated. Give it a thumbs up if you enjoyed the video. If you want the next one to your inbox and you're not yet subscribed, don't forget hit that subscribe button and notification bell. That will notify you whenever I put up a new video, which is pretty much once a week. Every now and again I can sneak out another, but normally once a week. And like I said, thanks for listening, and you can watch some other videos right there. Where is it there? 2 videos there. And click on my face there, and you can subscribe there and hit that notification bell. Thanks for watching. Until next week.